Over the last several episodes, we've covered two financial statements for BrightLeaf, the income statement and the balance sheet. And we've treated them mostly as two separate reports answering two separate questions. Did we earn a profit, which we answer from looking at the income statement, and what do we own and owe, for which we turn to the balance sheet. But remember, we framed all the four financial statements as a different way of looking at the same business. They're all connected to each other. So now that we've covered the income statement and balance sheet separately, let's take an episode here to understand how they work together. And the main connection runs through the retained earnings account we just met at the bottom of the balance sheet. Retained earnings is the total accumulated net income the company has earned over its life and kept inside the business. Because when a company earns a profit, it has two basic choices about what to do with it. Keep it in the business to fund operations and growth, or pay some or all of it out to the owners. Whatever it keeps gets added to retained earnings. Now at the start of this series, I said I didn't want to get too deep into technical accounting, and we'll still try to avoid deep accounting discussions for the most part. But for retained earnings specifically, we need to talk through the mechanics just briefly, because it's the key to how these two statements connect. And the basic idea is straightforward. The accounts on the balance sheet are permanent. They accumulate from the very beginning of the company and carry their balances forward year after year. The cash account, the equipment account, the loan, they just keep rolling forward. But the accounts on the income statement work differently. They're temporary. They collect a single year's worth of activity, all the revenue and all the expenses for that year. And then at the end of the year, they're closed out, reset to zero. And their net result, the net income we saw on the income statement, is moved over into retained earnings on the balance sheet. Then they start fresh for the next year. And in the middle of any year, the balance sheet will reflect the current year's net income in addition to retained earnings from prior years. So the net income from the income statement flows directly to equity on the balance sheet in the form of retained earnings. And you can watch this play out clearly at BrightLeaf. The company started on January 1st, 2025, so every account began at zero. In 2025, it earned $57,500 of net income, which was then closed into retained earnings. Though it does look like some of those earnings were paid out to owners during 2026, as the amount retained at the end of 2026 is less than the total net income in 2025 and 2026. We don't need to worry about that right now. We'll figure out what happened there on a totally different report, the statement of equity. Then in 2026, BrightLeaf earned another $98,320, which it also kept. Stack this year's profit on top of last year's and you get the $130,820 of total retained earnings. So the profit calculated on the income statement becomes a balance within the equity section on the balance sheet. Now to reinforce that connection a bit further, let's track one transaction through the two statements. We'll focus on the building BrightLeaf bought to operate in. Back when the company started, it needed cash to buy that building. It raised $400,000 by issuing common stock to its owners, and it took out a loan. We can't tell exactly the amount of the loan from the balance sheet here. The best we can do is say the loan balance at the end of 2025 was $137,604. But let's assume it was $140,000. So between these two funding sources, $140,000 in liabilities and $400,000 in owner's equity, their assets increased by $540,000 in the form of cash. Again, assets always equal liabilities plus equity, and that's highlighted here. Our liabilities and equity increased by a total of $540,000, so our assets must have as well, and they did in the form of cash. Then BrightLeaf spent $500,000 of that cash to buy the building, so our liabilities and equity remain the same, no impact there. The business simply converted one asset, cash, into another asset, a building. Cash went down by $500,000, the building went up by $500,000. Total assets didn't change. But then that building starts to wear down with use, and we have to record depreciation. We know BrightLeaf recorded $12,500 of depreciation on the building during 2026 because the building's accumulated depreciation account changed by exactly that much. Again, we'd have to look at the notes to confirm this. It's possible there's other activity in those accounts. But BrightLeaf is quite simple, and given that the building account stayed a constant $500,000 from 2025 to 2026, I'm confident we're not dealing with any disposals or additional buildings in that account here. So the building's book value on the balance sheet decreased by $12,500 during 2026. And on the income statement, that $12,500 shows up as depreciation expense, which lowers BrightLeaf's profit. And on the balance sheet, that same $12,500 piles into accumulated depreciation, which lowers the recorded value of the building. So our assets just drop by $12,500. And for the balance sheet to stay balanced, the funding side has to drop by $12,500 too. So where does it come from? Well, that $12,500 expense lowers our pre-tax profit. But remember, expenses also reduce the tax we owe. A bigger expense means a smaller tax bill. So the $12,500 of depreciation actually does two things on the funding side. Most of it reduces net income, which flows into retained earnings and lowers equity. And the rest of it reduces the income taxes BrightLeaf owes, which lowers their income tax payable liability. And those two reductions together will be exactly $12,500, matching the drop in assets. So the equation stays in perfect balance. The depreciation lowered our assets by $12,500, and that was offset by a combination of lower equity through reduced profit on the income statement and lower taxes owed. So you don't need to memorize that split or stay hung up on that exact example. The point I want you to take away is bigger. A single event, the building wearing down, simultaneously reduced an asset on the balance sheet, reduced profit on the income statement, and through that, reduced equity and liabilities. One transaction rippling across both statements at once, with the equation assets equals liabilities plus equity never once falling out of balance. Put simply, the income statement is really a detailed look at how some of our balance sheet accounts, especially retained earnings, change over the course of the year. But that does raise a natural question. Retained earnings is only one part of the equity section. The owners put in $400,000 of common stock as of the end of 2025, then another net $50,000 during 2026, to end at a total of $450,000. They've also accumulated $130,820 in retained earnings, and it would appear, at least with the limited information we have here on the balance sheet, that some of the earnings have not been retained. They were paid out to the owners of the company. And was that $50,000 increase to common stock for a cash investment made by owners, or did they use stock to purchase an asset, or for another reason? To figure out exactly what happened, we need to turn to a different financial statement. The statement of stockholders' equity. The job of that report is to provide detail on exactly what happened here in the equity section of the balance sheet over a period of time. So let's dive into that in the next episode.